Hi, welcome to globalinvestorradio.com. This is part one of the Ted Warren Investolator series, where I'm just reading a few excerpts from the book How to Make the Stock Market Make Money for You by Ted Warren. When a stock has had a fast move and heavy buying is taking place, it is natural for him to think that the majority must be right and he will buy. Mob psychology has infected him, and he is being led to the slaughter with the rest of the lambs. Then it comes naturally for him to be slow about making up his mind that he made a mistake, because he was so positive that he was right. Now wherever he takes a loss, it is natural for him to think it is going lower, and his losses will not grow larger, and in this case he is usually right. If he made a quick decision to sell at a loss shortly after buying his stock, it comes naturally for him to think that he made a mistake if he sees a following rally. If he should have the stamina to carry a stock down and into a dragged out bottom, he may sell because he has acquired a hatred for it, a reversal of his emotions from an earlier time when he had a large profit on the stock and he fell in love with it. During panic selling, the thinking that comes naturally is to sell. During weak appearing rallies such as followed the 1957 and 1962 panic, it became natural to think the market cannot go up. When a person failed to take a fair profit at a certain price, it comes natural for him to sell when it again reaches that price. More often than not, this is wrong. When considering buying stocks, it comes naturally to think in terms of fundamentals. For the average person, that is a handicap. Forget the fundamentals and pick your purchase from the long-range charts where you can see they are on the bargain counter. If you do not use charts, it comes naturally to ask your broker to suggest a good stock. Don't. Ask him to suggest a sound stock that is priced reasonably low instead, and believe it or not, it comes naturally to listen to tips and rumours. Does all of this seem exaggerated? Take my word for it, it is not. I learned it the hard way. What is an Investolator? In the stock market, there are two distinct classes of people, the speculators and the investors. The percentage of casualties among the speculators is unbelievable. Over a period of time, they have little chance. They are very much like those who bet on the horses. They tell about the times when they win, but seldom mention their losses. How often have you heard someone say, "I knew a fellow who plays the market, and he does pretty well." It is a safe bet that he only gave that impression that he did pretty well. There is some element of luck among investors, the timing of their purchase being the most important. Was the stock high or low when they had the impulse to buy it? The earnings of some very good companies can turn sour. Others can come up with some very pleasant surprises. The average investor's luck depends on a good deal on the source of his advice. It takes a certain amount of courage in customer relations for a broker to recommend a stock when it happens to be going through a period of low earnings or is selling at a deflated price. The first stock I ever bought was Case Threshing Machine, ticker symbol CTM, known today as JI Case. As I look back, now I realize the underlying influence that caused me to pick this stock. The word case was the first trade name of which I was ever aware, with its impressive eagles sitting on a globe of the world. As a young boy in the farming community in South Dakota, I always looked forward to threshing time and the fascinating sight of the huge steam tractor majestically pulling along the even larger grain separator with ease. I even thrilled at the sight of its winding tracks across the stubble fields. I was also influenced by a fact that I already knew, a little bit more basic, but not much. Someone had told me that the stock market was very low. I wish someone had told me that it was going lower, much lower. I found that CTM was selling below $120 a share, nearly $400 below its 1929 high of $509. I had saved money while working in logging camps out of Seattle, and was now working on the assembly line in the old Ford Motor Assembly plant near Lake Union. I had worked hard for my money, and I had a vague idea that I wanted my money to work for me. Until now, it was very vague. At least I had the beginner's common sense of thinking in terms of buying low, and had not become infected by the speculative fever which had become compulsive. The symptoms of this too common ailment show up in their worst form when they cause the trader to buy during a fast rising market. I opened an account of $1,000 to begin with and bought 35 shares of Case threshing machine at $118. I cannot recall why I didn't go the limit and buy more, as buying on a 15% margin was common then. It was not long before CTM touched 133, where I had a profit of over $500, on paper that was. I always had known my limitations as a relatively uneducated farm boy and labourer, and was happy on this job as a production worker. About all I knew was hard work. I never squandered money, having learned the value of the dollar the hard way. At this time I was getting the high wages of $7.20 a day, very high for what could be termed as common labour. About this time I began to take a dim view of the labour approach to making a living. My job was turning sour, or was it I who was turning sour on my job? I had just discovered an easy way of making a living, or so I thought. I was hooked. I had become a speculator. But it did not occur to me in such words. I thought in terms of buying low and selling high. Very good logic. I had a lot of experience behind me before I realized that logic is a factor that is displaced by emotion when you become a stock market speculator. A speculator's emotions are influenced by watching the tape and the daily quotations. He does his trading by that, and he thinks it is good reasoning at the time. Fear, hope, wishful thinking, rumours and mob psychology are also emotional influences that guide him. Also, I had not yet learned that the casualties among speculators are very close to 100%. Anyway, I had my sights set much higher for CTM and did not sell. There was no reason for my unsophisticated mentality to even guess we were heading for a depression. I have never even heard of such a thing. A few weeks later I sold out CTM with a loss. In my first venture in the jungle of Wall Street I frightened quickly. Now the pattern was set. A person should never buy a stock just because he likes it, or because he happens to have the money available at the time. Before making a purchase he should check its current price in comparison to its price range in the past. The simple way to do this is through the use of a chart. The very best of stocks have price drops or reactions often as much as 50% or more after large rises. It is far better to wait until you can buy more shares at a lower price with a higher rate of return. Patient waiting can be worth a lot even though you miss 2 or 3 years of dividends. There are many reasons why an investor may need the money and so decides to sell. The difference between taking a loss or profit is whether or not the purchase was made while the stock was in its high or low range. The investor enters the market with patience and slowly collects his dividends. The speculator enters the market with impatience and eventually loses. I would like to see the speculator forget his great ambition to get rich quickly. His imagination goes to extremes, but he thinks it is sound reasoning. His emotions also run to extremes as the market fluctuates. As these fluctuations control his emotions, most of his trades are based on them. When he takes a loss, it is because he is afraid of a further drop in price. When his losses are piling up on him, he is probably losing sleep. When he sells, it is a form of relief. Now his losses can no longer grow larger. Often he sells near or at the bottom of a dip, and when the price rallies, he condemns himself for making that mistake. He has lost his position, so invariably he buys back on a rally. If it is only a rally, he soon finds himself again with a loss, and again will sell. This can happen several times in succession, and can happen in both a rising market and a falling one. This is called being whipsawed. When a speculator has purchased a stock, especially if he has held his stock for some time, he is apt to take a profit too soon. It is impossible to beat the market taking small profits. On the other hand, if he has held his position beyond the small profit stage, there is a strong tendency to set his sights too high. His usual reaction then is to think that the stock is going higher. He sees extremely heavy volume and boiling action or violent fluctuations on his stock. Instead of associating this with other top actions that he has seen in the past, it only blinds him into overconfidence and wishful thinking. Nearly all that he hears and reads about the stock is favourable. Any comment that is unfavourable he ignores. The compelling influence of the market action can be powerful. He is beyond any logical reasoning. Even his best friends can't influence him if they disagreed with him, but usually they have been caught up with the same line of thinking. If he was lucky enough to have sold out near the top, he may start feeling for the bottom far too soon. When the stock has dropped 25%, it may appear cheap to him, and of course he can be right at times, but feeling for the bottom is an expensive way of finding a bargain. Usually when a stock has reached a bottom range the speculator has become too pessimistic to buy. Also, if he does buy when it reaches the bottom range, he is buying too soon. There is likely to be a long wait ahead before another rise. Discouraged, the speculator will invariably sell, usually at a loss. By now you should be aware of the fact that I am against speculating. You are right. If the speculator can take the advice that I am able to pass on, he can save himself from those speculative headaches and financial losses. Making money in the stock market can be done as a speculator if you know how, but gaining this knowledge is probably one of the most difficult skills to acquire. The average investor who sits tight through it all is less affected by the hot and cold waves of emotions that the speculator goes through. He leads a more serene life, his mind is not diverted so much, and he can give better attention to his regular occupation and family. I have seen the time when I was reluctant to go on an extending camping trip with friends when I expected critical action in cotton futures. The investor, as you see, can even enjoy his vacations better. My purpose here is to get the speculator to simmer down and acquire the patience of an investor. The speculator is inclined to think of the investor as a fuddy-duddy, too slow a thinker to be in his fast company, but the pitfalls are too numerous for the speculator to cope, and he can rarely escape them all. Now if he will admit defeat and join ranks with the investor, I will try and be a little bit more on the positive side. I will admit that I have sounded quite negative on the subject of speculation, and will also admit that it has been purely intentional. I would like to coin a word that will describe a new category of shareholder. This person would be classed between the investor and speculator. The best idea that I can come up with is a combination of the two present classifications. I would term a person in this third classification an Investolator. An Investolator would buy like an investor should, and sell like a speculator hopes to. He should have the patience of the investor, but with his sights set for a large long-term capital gain. It should not be very difficult for the investor to change to this new Investolator category, but once he has and gets used to the change of pace, he must be careful not to be attracted into the role of a speculator. The speculator will find it more difficult to be converted and stay converted. He has been used to making many decisions. He will be inclined to watch the market too closely and may fall back into his old habits. If this happens, he had better join Speculators Anonymous. To be an Investolator, you must also be chart conscious. I do not mean that you should keep daily charts and try to interpret each juggle and movement. It also takes intuition to understand why certain actions discourage a person into selling and other actions incite him into buying. Few can begin to interpret these short-term actions. The charts you will study in this book are long-range charts. Many of these charts show curves that, from a money point of view, are as attractive as some of the curves pictured in Playboy. While the curves you see in Playboy are formed by nature, the curves you see in these charts are formed by the mechanics of the stock market and the emotions of the public. You will be fascinated by these pictures because you will see at a glance whether stocks are in their high or low price range. You will really become price conscious. Stocks that you have maybe thinking of buying because they were good stocks, you may easily recognize are too high. If you will study these pictures with an open mind, I will show you why the sleepers are the bargains, and that they are the ones that have the largest profit potential. Okay, that was just the introduction to the Ted Warren book, How to Make the Stock Market Make Money for You. It wasn't the full introduction because of copyright. I just put some of the introduction down there for you, and I just thought I'd finish off the screencast here with a perfect picture. This stock would have been very pleasing to Ted. Great accumulation action here, flat top triangle, breakout, and then a movement up, and then another movement up. And this 45-degree line which Ted talks about in the book being broken, that would be the selling point about there. And then it begins another cycle of consolidation and accumulation. So whenever you see a stock like this in the future, look back in history. Most of the time this signifies some very professional, strong hands coming to the market and supporting the market, expecting much higher prices in the future. Okay, check out the Oak Trader Report, released every Sunday. It's based on the methods of Ted Warren and other old school traders that have the same type of philosophy and methods and techniques. Okay, over and out, and I'll speak to you soon. Bye for now.